Hi, welcome to this special conversation on BQ Prime. I'm Tamanna Inamdar. IT stocks have been in focus, with many of them getting the thumbs down from investors post their quarterly results. I would say LTIMindtree is an exception in that sense. Their Q2 numbers were announced yesterday, and after that con call, the stock has been doing fairly decently in a relative term today. It has got that thumbs up. Why exactly is that? One of the reasons is a relatively optimistic and robust guidance that the management has given going ahead, between 17 to 18%. What is behind that optimism? To speak on this, I'm joined now by Sudhir Chaturvedi. He's President and Executive Board Member of LTIMindtree. Mr. Chaturvedi, thank you so much for speaking with us today. I hope you're doing well a day after those numbers are out. And let me put that question to you that I've mentioned in my introduction. Where is that optimism coming from for a relatively more robust guidance?
Yeah, thank you, Tamanna, and it's good to speak to you this morning. In terms of our what we've informed investors on the calls as yesterday was that our H2 will be stronger than H1. And the reason we believe in that we're confident about that is the order inflow that we've had over the last 2 quarters. So we had $1.4 billion of order inflow in Q1 and followed by $1.3 billion in Q2. $1.4 billion in Q1 included a large renewal contract, whereas the Q2 revenues are order book are mostly from new deals that we've won. So the combination of those two, the order inflow that we've had in H1, as well as the nature of the order inflow, makes us confident that we will continue to grow in Q3 and Q4, and therefore our H2 will be, better than our H1 in terms of growth.
On that investor call yesterday, there was also talk about the margin improvement program. Can you give us a bit more detail on that? What exactly are the mechanics of this program?
So as the two companies got together, post-merger, we had capacity in the system. So we essentially focused on maximizing utilization. So if you see the utilization is at 87%, which is an all-time high for us. And we continue to be comfortable, at that range. We've also had employee addition this quarter, significant employee addition this quarter. And we will continue to operate in that utilization range. That has been the biggest driver. In addition to that, there have been merger synergies that we've exploited. So there are certain merger synergies in SG&A. There will be more merger synergies which will come in future through real estate consolidation, et cetera, that will happen in subsequent years. But there were some SG&A areas that we could look at. And last but not the least, we are also seeing how we can, use technology more efficiently to drive more productivity within the business. So the combination of these 3 factors is how we're doing margin maintenance here.
You spoke about your order inflows and 30 new clients this quarter. One big theme, I think, this result season, especially when it comes to your sector, is whether those order inflows and those robust order books are actually translating into revenues, margins in very uncertain times when things sometimes change. Can you give us your view on that and some perspective on that? Is there some sort of choke in that pipeline? What are you experiencing and seeing?
Yeah. Actually, interestingly, we are seeing a, very robust pipeline. Actually, the conversations that we are having with clients are at a record high. The number of large deals that we currently have in the portfolio and the value of them is also at a record high. So most of these are cost takeout deals, efficiency deals. That's over 75% of the deals that we're looking at are of that nature. As clients are fundamentally looking to rejig their cost base from a tech perspective after 3 years of quite strong spending that they've done in technology. So I think it's an expected efficiency cycle, and that's something that we are seeing. I think post-merger, what we've seen is that our deal invites have gone up significantly. We have several deal advisors now reaching out to us almost on a weekly basis for deal invites. And that's the reason for that is that I think we are seen as the best alternative to the tier 1 players where clients are looking to see if there is a switch that they're looking to make. So that's the kind of pipeline that we see. Now, in terms of that translating to revenue, What's also happening is in a cautious spend environment, the discretionary spend has reduced considerably. So what we used to have as discretionary spend is now being actually fulfilled by these new deal wins. But what we have is with the quantum of new deal wins increasing, and these are large multi-year deals, we'll begin to see, when the cumulative effect of those deal wins, we will start to see in Q3 and Q4.
So you talked about how you're being looked at a great alternative to your tier one companies. What is that competitive edge in this environment?
Well, I think we're a breath of fresh air, frankly. As the two companies have merged, there's excitement within the organization. We're, close to 90,000 people now, so we have the capabilities. And we have focused verticals, so we focus only on a certain set of verticals, and we can maintain that focus even post-merger. So in those verticals, we have the capabilities of any of the large players. And then we have the speed, the agility, the nimbleness, the responsiveness, frankly, of a player, of a smaller player. So I think we bring the best of both worlds to clients, and that's something that they're beginning to see.
Having said that, let me talk a bit about your verticals and your BFSI segment. I think about 5% growth in this vertical. Are you looking at a continuing sort of headwind there, especially from your big base, North American base, about 74% of your business? Do you see the pain points there continuing, looking at where the US economy is heading? No one's talking of recession anymore, but the fears are very much still there.
Sure. So, what we've seen in BFSI is, and if I break BFSI into banking and insurance for us has actually been quite robust. We've got approximately 10% growth in insurance YOY. And that continues to be robust because clients in insurance are investing in modernizing their technology stack in a very significant manner, in spite of all the cat losses that they've had due to weather events more recently. That investment cycle is still being maintained. Banking is where we are seeing caution in spending, as well as freezes in onboarding new resources. So that will continue into Q3 as well. We also expect that I think it's a good time for me to also say that in Q3 this year we're expecting more furloughs to be higher than in previous. So post pandemic, we saw furloughs reduce. Now furloughs are going back to how they used to be pre-pandemic. So we're going to see furloughs in banking. Is a sector that traditionally has these furloughs in December. So overall, BFSI, I think we're still confident that it will continue to grow even in the second half of the year. But what we are really looking forward to in the second half of the year is broad-based growth across verticals. So, for example, our retail and consumer goods vertical, retail, consumer goods, travel, transportation, and hospitality, basically our consumer sector-oriented verticals, are actually seeing a good uptick based on the deal wins that we've had and the continuing deal pipeline that we see there.
Let me talk about your attrition rates, which have moderated and continue to moderate. Do you expect that trend to continue? We've seen that steadily over the last, I would say, 4 quarters. And do you see that trend continuing?
Yeah, we're approximately about 15.4% now. And I think we will see that trend, in that. I think traditionally we were in the 13 to 15 range, so we will see it sort of settling back into that range. And what we are seeing is that, as we grow, we're the ability for us to continue to add resources in line with demand is there. The kind of pressure that we had seen on supply in the past has reduced significantly. So which also helps in terms of us managing our costs and also ensuring that we are responsive to our client needs.
I want to just come back on your outlook and, the base sort of point of you're expecting H2 to be better. In your view, do you think the worst is over on the US macro front? Because nobody is very clear what's happening there. How are you looking at it going forward, and how are you preparing for an either-or scenario?
Sure. In fact, this is the budgeting quarter for most of our clients, and most of our clients, especially in the US, have a Jan to December year. So this is the quarter where the budgets tend to get finalized. Now, notwithstanding the recent events that have happened in the last 2 weeks, because it's too early for us to know exactly what that impact on our client budgets are going to be. But I think it's fair. It's sort of safe to assume that there will be some. It'll lead to more caution. So I think what we were already hearing from clients. That there were going to be more caution in spending, even continuing into the new financial year. But what they are focused on is efficiency-led deals. I keep telling my teams that I'm very happy to be in the cost reduction business. It's a great business to be in. It's something that we are extremely good at. So it's not like it takes away opportunities for growth, but what it does is it reduces the opportunities for growth through discretionary spend. So then we need to shift our emphasis to growing within the existing spend areas, essentially to take market share away from others.
Does that also impact deal sizes, though? The cost reduction business, are those spends then lesser than discretionary spends?
So cost reduction, actually what happens is these are usually 3 to 5 to 7 year deals.
Yeah.
So they're longer term deals. The TCV of these deals tend to be higher. Yes, these deals are hyper competitive and clients are looking for savings. So there's always pressure that it puts on pricing from that perspective. But as long as, we've got strong solutions, we've got some really good AI, intelligent operations solutions that are in play where we know that we can actually deliver the cost savings that the client need as per our margin expectations. So I think we can balance that out based on the investments that we made, especially in our AI-led tooling in this space. So I think for us, this is actually good news because we get secular revenues over a longer period of time, and also these programs have a ramp-up time. So there's a ramp-up phase, so you can plan and execute much better. And you can also make sure that the team size and the team composition is more appropriate to these kind of deals. Whereas with discretionary, it's almost always just in time, resourcing and looking for skill sets which are sometimes scarce. It's a different business. We ideally like a combination of the two, but yes, today's scenario is much more around cost-saving led, deals and pipeline. But we are happy with that, as long as we continue to win in that space, we'll continue to grow.
Just because you spoke about AI and it's everyone's buzzword, and by everyone, I mean everyone, even companies that are not in your space are getting into AI now. What is that landscape like? Can you share anything new and exciting happening there?
Yeah. I think from the perspective of LTIMindtree, we were always very strong in data. Data is our largest practice unit in the organization, and that gives us a good base for us to look at AI initiatives. We also have our own data platform called Phosphor, which is an AI-led platform. So we actually entered the space earlier than others. Now, what we see with Gen AI is that we're using Gen AI across the board in the organization. In fact, I think the easiest way for me to describe it is that everything that we do for our clients, from the way we develop software to the way we maintain, software and hardware, to what we do in testing, in each and every area, we have an AI-led intervention in each and everything that we do. So it's almost like we are an AI inside company in everything that we do. In addition to that, clients are looking at very specific AI use cases, especially in the customer operations side of the house. So contact center, CRM, these are the areas where we are seeing significant investments. Marketing continues to be an area of focus from a Gen AI perspective. So we have about 100 odd conversations going on and 22 active engagements, which are just Gen AI focused. But all our large deal wins that we've had recently, that DC spoke about in his opening comments yesterday, are all AI operations led. Where we infuse AI into how we deliver operations led efficiency to our clients.
All right, that's exciting. Thank you so much, Mr. Chaturvedi, for speaking with us today.
Thank you, Tamanna. Such a pleasure.
Likewise.